Okay, on the line with us we have Jay Hinrichs. Jay Hinrichs is the founder of True Wholesale Houses. And so what we wanted to do is give an opportunity for potential investors to kind of hear directly from the horse's mouth, kind of why the concept came about, and we'll answer some tactical questions on how to kind of get involved, and we'll also address how we arrive at the 15% cumulative return over time, which includes your interest rate, your interest payments on the note, and the equity position that you have coming into the property. So, Jay, why don't you tell us? Well, first of all, let me thank you for making the time to do this with us.
Well, it's my pleasure, John.
And why don't you just start off by telling everyone a little bit about yourself and your background?
Well, John, I'm pretty much lifelong real estate broker and investor, also a licensed mortgage banker, and have a lot of experience in the single family realm, either making loans on them, like I did the last 6 or 7 years. I've done over 1,000, 1,200 loans for mainly people in the that were buying properties for cash flow or fixing and flipping them. And so that's given me some pretty unique perspectives, analyzing this asset and this space from a lender's position. I get to see, what people are paying for them, what buyers are buying them for, cash flow. Got a really good perspective.
Okay, and that kind of led you into competing with a lot of, I guess, what we call these wholesalers out there that are selling these types of properties, these cash flow properties. You want to tell us how it kind of originated?
Yeah, what happened is like any lender, in '08 I had about a $25 million portfolio out there. And of course there was a meltdown, and, we took our lumps along with every other bank in the world. And so what I did is I just looked at our lending practices and what would I have done different if 2020 hindsight. And the biggest thing that I saw, and the biggest failure in my clients that weren't paying me back, was that the wholesalers and the investors buying the property, people were ripping all the equity out of them up front, and they were over leveraged. They had too much debt on them, and so when you had a little bit of a change in the market, a little bit or a lot, the investors became less enthused and started to walk away from the properties, or they didn't engage correctly with their property managers, and the property management aspect just became a nightmare. And in talking to my borrowers, the big thing would be, oh, this is not working the way the wholesaler told me it would. They told me I would get, X amount of cash on cash return, and I've had to do the water heater, and my property was vacant for 2 months, and they didn't tell me this, they didn't tell me that. My property manager won't call me back, all those kind of issues. And that's pretty much, I started taking that information and formulating a plan that would better protect the investor. And that's what I've come up with.
Okay, so essentially, what you saw in the past was wholesalers selling properties with, I guess, a profit margin in there that didn't leave any room for a good equity position or a good enough equity position for these investors. And then they were just doing a poor job with the follow through. Once the investor purchased the property, they kind of weren't hands-on anymore.
Well, that's right, John. Every single wholesaler out there has the exact same model. We buy the REO, we fix it up. Everybody's entitled to a profit, so they sell it for as much as they can, because that's their business. That's how they run their railroad. And then they introduce you to a property manager who's usually their guy they've vetted really well. They all have the exact same scenario, exact same speech. And they shake hands with the investor, and they're down the road. They're out of the deal. They've gotten all their money. There is no other benefit for them to stay with the property, and they're out looking for the next deal. And you are in the hands of a property manager at that point.
Gotcha. So then you're just managing your property manager from that point forward.
Exactly. And that is a job in itself. That's where the disconnect comes in on all the, in the thousands of transactions I've seen, the couple hundred properties I had to take back personally, the disconnect came at property management, and there's just horror story after horror story of investors getting into these deals, and not only did they not positive cash flow, they severely negative cash flowed, and they negative cash flowed them right out of money to where they no longer even had the money to pay their mortgage payments.
Wow. Well, it's an interesting model, and if for those investors that have never purchased notes before, can you give us kind of the simplified version of what they are actually buying? And
yeah, the simplest way is they become the bank. They're the beneficiary of the deed of trust. We leave the owning and the running of the property to our company, which has vast experience in doing this. We have systems and in place. We give our and our people on the ground that are managing the property or managing our tenants are our partners. They're not third-party vendors. They're going to be here long term, because what I've done is I've incentivized everybody to stay in the deal, because that's where our equity is. When we get our equity is when our investor gets our equity. We don't get it ahead of the investor. The investor doesn't get it ahead of us. We all get it at the same time. What this does is it incentivizes my team to stay in and do the very best job that they can, because at the end of the day, that's their payday. And that's where the big disconnect comes from, wholesalers taking 100% of the profit out of these deals up front.
And so just so our listeners understand this, then they're not in it for the money they're making on the front end like your traditional wholesaler would. They're in it to make the money on the back end of this, so they have to manage the property a certain way. The motivation to find the right tenant's a little bit different, and because you and your team own the property, renovations are done a little bit differently as well up front. So everybody has the same long-term interest in mind, and everybody's shooting for the same thing. Can you explain a little bit how you arrive at creating these teams in these various markets around the U.S.?
Yeah, the teams that I have in our markets are people that I met them as borrowers years ago, and they have large portfolios of their own, anywhere from 20, 30 of their own rentals. But they're like a lot of people. You can't borrow any more money from the bank, and they got pigeonholed. They couldn't grow their portfolios any larger. And we came in with our program to help them expand their portfolios. But this is what they do for a living. They manage their, rental property. And and also when we had our issues in 2008 with the, the foreclosure mess, these are the people that didn't run away from me. I mean, I had probably 50 or 60 clients across the United States that I made them hundreds of thousands of dollars by providing the capital for them to flip houses to cash flow investors. And at the end of the day, when everything went bad, there was only about 4 or 5 of them that would even return the phone call. They're all out of the business, or they didn't care because they already got all their cash up front.
That speaks millions yep. about the people you have on the ground, because our industry is unfortunately riddled with people who are just they're short-term thinkers, and they burn relationships that way.
No, this is a slow and steady wins the race. We're all building a large portfolio of rental properties, and instead of if this was 4 or 5 years ago, I'd be going to my bank. I'd get a $5 million line of credit, and I'd just go buy these on my own. But those lines of credit are no longer available to virtually anybody, and so this is why we have to go out and bring our investors in. Our investor, who's the bank, and bring in private individuals and basically, share the equity and share the cash flow.
So under the program, then you've created a way for an investor to put up anywhere from $20,000 to $50,000 and essentially partner with these experienced property managers in these various markets.
Right. So what they do, the form and function is they're buying the note. They become the bank, the beneficiary of the note. They have a first deed of trust. There's no other debt on the property. And then in the note, there's a participation clause that states that the note holder and the owner of the property, upon the sale of the property, will split the net proceeds 50-50.
Okay, so let's walk through kind of a bread and butter scenario. We have a property that's valued, market value is about $60,000, and we're talking true market appraisal right now. And I buy that property. Let's call it the note on that property would typically be right around the $35,000 mark. Okay,
That's correct.
So I buy the note for $30,000. I am now the note holder, and that note secured by that physical asset that you and your team continue to own, but I get to share the profit on that on the back end. And in the meantime, you're making interest payments to me to the tune of what, 7 to 9%? Is that right?
Yes. Depending on the asset, between 7 and 9%.
Okay, and that's the annual return, just so everybody's clear, and it's paid monthly.
Right, exactly.
So that monthly payment, then, if we're looking at this from almost like it's essentially kind of an informal partnership that we're creating here through the structure of this note program. If I'm an investor, how much of the monthly payment that's being collected from the tenant am I seeing by virtue of my monthly payment that's being returned to me?
Well, on the on our typical 9% model, by the time we pay, there's no management fees that we pay because, again, our partners are our managers, so we don't pay them. Any maintenance that we do is done at cost. It's not marked up. And so by the time we pay taxes, insurance, we put $200 a month into our reserve account for each asset. That's the other thing, and just if I sidebar here, people that are buying rental properties grossly underestimate what it costs to maintain them. And they're wholesalers that are selling these properties. A lot of them don't even put a maintenance reserve in. They'll just say, oh, this house was just freshly rehabbed, and that's just grossly wrong.
Right.
Anyway, then we put $200 aside to make sure that we have plenty of money in the kitty to keep the house in tip-top shape. And then at the end of the day, our investor is getting about 65% of the net cash flow. We get about 35%. That's where we make our money, and we do it on volume. We're putting 10 plus units a month into production and out into the public with our investors. And that's our goal is build up a large base of homes in our market, and we're going for cash flow. Plus we have 50% of the equity, which is usually double the amount of the note. And, it builds up our equity base really quickly, and our investor has nice true equity day one. Because you have to remember, John, they're not going to go out and buy a house that's renting for $780 a month from any wholesaler in the country for $30,000.
Right, exactly.
That house is going to go for $55,000 to $60,000. We are giving them true equity day one.
Exactly, and I'm very familiar with one of these models. So to kind of simplify what you just said, or just say it another way, then if I was an investor, I'd give you $35,000. That would purchase the note. My payments that you're making to me are about 2/3 of what the net cash flow is going to be on that house after a vacancy reserve is accounted for, after the maintenance reserve is accounted for, and after all your hard expenses like your property tax and insurance. So really, I'm making the bulk of what's left over on that rent after all the expenses, and I get, if the property doesn't go up one penny in value, and I pay $35,000 for a $60,000 or $70,000 property, then I'm walking in, if I take, if we're looking at half of that equity, then I'm walking in with not only those monthly payments that I'm getting on my $35,000, but also an equity position. Just my half of it would be anywhere from about $15,000 to $18,000, somewhere abouts.
That's exactly right. Those are the properties we look for, and they have to meet those criteria to fit our model and get presented to our investors. So they're going to get a 7 to 9% cash on cash return. If for some reason we have a vacancy, that's on us. It's not on the investor. They always get their monthly return. And at the end of the day, I'll put this model up against anybody trying to do this on their own, or anybody out there, telling people, oh, you're going to make a 15% return, because I just know you can't. It just doesn't happen if they're doing it on their own, because they're going to have maintenance issues, they're going to have vacancy issues, and if they were really honest with themselves, most people make under 10, and a lot of times they're negative. I mean, that's what I've seen after doing thousands of these transactions.
And to add to that, some of the best markets to buy in where you get really good rents relative to a very low purchase price are in markets that we don't live in. And so if not only are we not getting the financial performance that we are anticipating when we buy these, but we're allocating a lot more time and energy and stress trying to manage these properties remotely. And this is just a way for you to team up with somebody on the ground that is going to bear the burden of all of those phone calls, and you just keep continually collect your monthly payment as the investor. So that brings me to another question. I was thinking, kind of worst case scenario. Mom always told me that anytime I spend money or invest in something, I have to consider my worst case scenario. Worst case scenario in this situation would be I buy the note for $35,000, and for whatever reason, your team stops making the monthly payments on my note. How do you get around that scenario or offer peace of mind for an investor with a scenario like that?
What we do is we'll sign a deed in lieu of foreclosure, and we will have that at our closing attorneys with pre-signed escrow instructions. If we haven't made a payment in 90 days, the deed in lieu of foreclosure will be recorded, and the investor will own the asset free, with no liens, and our equity goes away, and we've lost everything we've put into it.
So it's a happy scenario, assuming that the market just doesn't tank, which we're not anticipating. But if you're making the payments, I'm getting my fixed return with an exit in 3 to 5 years to realize half of my profit or half of the equity on the sale of that property. And if you don't make your payments in 90 days, I would own the property at that cost of my $35,000 outlay, essentially at your cost. And
that's exactly right.
Okay, and I won't have to do anything.
And that's not going to happen, because I'm not going to be allowing our equity to just to go away, because you have to remember our rents are 3 times what our payments are, and the majority of our rentals are government guaranteed. I mean, we have guaranteed rents coming in. There's no call to not make a payment and then allow an investor to wipe us out of our equity position.
Great. Okay, that makes a lot of sense. So it's a happy scenario either way. Now let me ask you this: for those that are interested in exploring further, obviously we would get them in touch with you directly. But then, when they're ready to pull the trigger and buy one of these notes, can you walk us through logistics? What is that process like administratively?
Oh, this is one of the things I just love about this product. It's a 2-page document. It's a note purchase agreement and escrow instructions. We close through First American Title, which is one of the largest, if not the largest, title insurer and closing company in the United States. The note investor would sign that. It would go to the title company. They wire their money in. The escrow instructions call for 6 things to be done before they can disperse funds. They have to hold, for the benefit of the investor, the original note, copy of insurance naming them as the lost payee, just like you would give it to a bank, the note assignment, the note endorsement, and the title insurance. We, of course, buy these properties with title insurance. Everything has title insurance, and the title insurance automatically runs to anybody who to heirs and assigns of a property, and so they get their title insurance. They don't have to pay for it again, and the transaction is done. We set them up on an ACH, and their payment, and we'll prorate if they buy in the middle of the month. At closing, they'll get a prorate check for their 9%, and then their payments come on the 15th of the month, and we can, like I said, we'll either send out checks or ACH them into their accounts, and then it's set it and forget it. They don't have to worry about the asset. We send out some blogs and how's the markets, and we stay in touch with our folks. The other thing we need to point on is the exit of these. Is we write these notes for 5 years. At the 4th year, we're going to contact the note investor and tell them, okay, our note is coming due. The property is going to go on the market. We're going to sell. And but we will also give them an option if they're enjoying their 9% cash on cash. We'll extend out another couple years. So we're not in a hurry to move out of these assets, because it's a once in a lifetime that we're buying these assets as inexpensively as we are. So, and I know 5 years from now we won't be able to recreate them. We won't be able to recreate that kind of cash flow. So it's really the investor's call. We're a true team player, and we want our investor to, they'll come back to us with the next greatest deal that comes down the line. We're building a big, large team here.
And I think that's a really important distinction for everyone to hear. It's worth reemphasizing, is that you're not in it to simply make money for the team, if you will, and start a business just to make money on these. You're in it to be a solution provider for investors long term. And
absolutely.
You're building a family here of investors that will follow you for every great investment opportunity that's coming down the pipe here long term.
Yeah, John, I worked real hard in my career to be able to be bankable. And like I said, I got bankable up to the tune of $20 million worth of lines of credit. And in the financial crash, 3 of my 4 banks, called our lines of credit. We don't want to do real estate anymore. And I said to myself, I'm never going to put myself into that position where I can have a $25 million company one month, and then the next month they don't like you anymore, and they want to, they want to get out of that industry. And that caused the crash of the real estate market here, the lack of liquidity. Because I'm not the only one that happened to. Builders all over the country and other folks. So we need to have private individuals as our investors. We need to bring them in as true partners, take care of them, and if we do that, our job, it makes our job real easy, and we put out a superior product.
That's great. I'm super excited about the model, and just to kind of summarize the process.
John, I wanted to add one other thing, because I know that you deal with a lot of folks that are offshore, and some of the real estate chat rooms I get into from Australia and England, they're real heavy on liability and LLCs and everything. That's one of the great byproducts of this model. They have zero liability. They're the bank. They have no liability on these properties. You don't have to they can take title as the assignee in their personal name. No one can go after them for anything, because they're not the owner of record. They're just the beneficial interest of record.
Right. And because of the property insurance that you're purchasing on your end, that they have proof
right.
of, if there are any claims, they go directly to you. And
yeah, I'm the insured, and we have a big master commercial policy. And if the property were to burn down, you have a fire, the investor gets paid first, and then we split the equity. If there's a claim, we would split any money on top of that. So,
excellent. So, just to kind of recap the simplicity of all of this, if you are an investor and you're interested in partnering with the group, and you want to kind of leverage the team that Jay has on the ground that are actively acquiring, renovating, and managing cash flow properties in emerging markets at heavily discounted rates, then you would simply, number one, give us a call. We'd be glad to talk to you and answer more of your questions in depth. And then when you're ready to commit, we would just simply send you a 2-page purchase agreement. You get that back to us, wire funds. And then within 10 days, you would hold the note, and then within 30 days after that, you're receiving your first checks on automatic draft. Then you'll be contacted in 3 to 5 years to see if it's an optimal time to exit or to sell the asset, so that everyone can realize the profit on the back end. And if it's not a good time, then we'll just wait until we hit critical mass with the market. So anyway, I appreciate, Jay, you spending the time with us. Again, if anyone has any questions, let us know, and we'll make sure the contact information is readily available so you can engage. Thanks a lot, Jay, for your time.
Thank you, John, and have a great day.
You too. Bye-bye.
Okay, bye.